Hey everyone, welcome back to the Finance Weekly. So let's talk about the Fed first things first. So we already know what the suits and the Fed are all worrying about. So they're not so worried about bond yields anymore. We can see tech stocks going to the moon. S&P 500 just reached its all-time high because of tech stocks rallying. So they were worried about this little thing, doodles and stuff. Now they're over the shock of rates and bond yields and all this stuff. So now the whole market is kind of like, okay, all right, cool. We're not freak out about bond yields anymore. So everything's kind of still in shambles in terms of EVs and tech, and even recovery is down a bit, and the indexes are flat, and it's the weirdest, most cagey market ever to be. And that's because we don't really seem to have a clear direction. But what we do have is more insight from the Feds in terms of what their inflation expectations are. So let's talk right into it. So, we can go, we're gonna start now. So let's jump on over it. So here's what's actually kind of happening. So we've got to understand that in 2020, obviously the Federal Reserve swooped in to bail things out they said, okay, emergency lowering the rates to plummeting their to zero. That was 2020. Something interesting happened at the beginning of 2021. The chairman, Jerome Powell, got a little pissed because that's Jerome Powell. He kept being yelled at about, come on, man, we know inflation's coming. What's going on? Like, dude, I've been telling you all since 2020, I want inflation to come. No, inflation's coming. I've been saying inflation is coming. We want in, and we literally have been saying we want there to be inflation because we want inflation to go to 2%. In fact, we want it to run hot. And even though we want inflation to go to 2.5% or potentially slightly above that or a little bit period of time, we're just going to call it FATE. That's what we're going to call it, flexible average inflation targeting, FAIT, FATE. And it'll all be fine. Inflation will run hot and it's cool. And so as soon as we start seeing inflation's market freaks out and throws a hissy at tech, and we're all beat down. And if we get February 16th top of the market to February 19th beginning of the crash, essentially March and now, even though lately it's kind of felt like things have been recovering, a lot of things are still left behind because everything is kind of a mess. So we had pissed off Jerome Powell of the run, and is basically, or was getting back in the market going, dudes, this is what we planned all along. So we ain't doing anything wrong right now. Just keep the rates where they are. The last thing the market has wanted was Jerome Powell had always been there to just print money to solve problems in the market. And now he's like, I ain't doing anything. I see some inflation fears. I see higher bond yields. I ain't doing anything because that's what I want. I want higher yields. I want inflation. Inflation not too high, like 2 to 3%. So pissed off Jerome Powell lasted about 2 weeks, and after pissed off Jerome Powell settled down, I still remember it was like a Thursday. I was watching Meet Kevin's live stream, and the market was basically just tanking when he was talking. But okay, so pissed Jerome Powell did not work. He's like, okay, you gotta be chill, Jerome. I gotta treat everybody like the true weenie babies they all are. That's what Meet Kevin said. But okay. So he doubled down on the things that you don't have to worry. I'll tell you way in advance if there's something that's going to be fishy, it's out of control, inflation goes way too high, or whatever. But yeah, this is what he basically said. But he said there's nothing to worry about, bond yields and all that's all part of my plan, so you just got to follow with it. So this is all the beginning of 2021. So what we are expecting going forward, and we're going to expect continued support, at least now from the Feds. So $120 billion of monthly bond buying, $80 billion of treasury bonds, 40 of mortgage-backed securities. So we're going to continue to see the Feds still saying how important it is not to have stable prices, but we should have maximum employment. And when they say maximum employment, they're talking every race, sex, and this basically calls to sex equality and race equality. And so he said, even though we might see temporary inflation, short-term hikes like we've been always talking about, you shouldn't expect that inflation to be persistent. The supply chain issue is causing lumber sheet, metal prices, used cars and houses and stocks and pretty much everything we can think of just going straight to the moon. But he said, don't worry, this is temporary. So Jerome Powell says everything's temporary, it's short term, it's part of his plan, and he knows what he's doing. So what again, we got a little bit of a clue on. So 2021, what we got today was pretty unique because it's subtle, but even though I think everybody a lot of people could have seen it, not a lot of people have been talking about it. So you were talking about when this inflation, this short-term spike, is going to start subsiding and going down. So of course, eventually, after probably a few months to maybe a year span, inflation is going to go down again. This is what he says. And once we see temporary inflation go down, then we know how the Fed might be able to respond, just to give you an example. So this is the Fed's version. So let's say right now in the Fed's world, we're at 1.7% inflation. That's what their version of inflation is, not ours. If you go to the market, they're like freaking out. It's like 4, 2, 3, 3.5, and all of that. But okay, in their world, we're talking 1.7 to 2%. Say, like, of course, we're still in their word. Inflation, the short-term spike would go as high as 2.9, maybe 3% if you want it. 3%. We're going to say 2 to 3%. This thing lasts, say, 6 months. At some point, you're not exactly sure, but the Fed gave us a hint today at some point that inflation is expected to subside, to trend down backwards. Or maybe, as investors a lot of them are fearing, it will just go up to the moon, and this is where we'll have a lot of bigger issues and a lot of stuff to resolve. But say, like Jerome Powell is saying, it's short-term spikes, I know what I'm doing, it's part of my plan, now it's going to come trending down. So say it trends back down, this 2 to 2.93% on average becomes 2.3%, say. And this is where the Fed expects to raise rates after this inflection, where it keeps going down over, if it goes over 3%, I think when we start realizing, okay, maybe we need to tighten sooner. But until we get to that 3%, you're probably not expecting the Fed to do anything. 2.9%, that's 2.5, fine. To anything lower, it's fine. So whatever, when that starts trending down according to them, we're going to hit a new number, say 2.3%, that's what I said. Okay, 2.3 for maybe 2.2, maybe 2.4, but okay, doesn't matter. So when that number comes, this is probably when the Federal Reserve will want to say, okay, so we went through this temporary inflation I talked about. This is exactly what I told you. So we saw this short-term spikes. It went as high as 3% from a 1.7 on average. Then it came back down to 2.3. So that we went through that period. It's all done. Inflation readings are starting to trend downward, and now they're going to settle at some place, ideally in this perfectly scripted word that scripts always work for anyway. When inflation hits this new level after the temporary inflation spike and it starts trending down, that's according to the Fed will probably be most equipped to say, okay, guys, look, it went down. We're averaging at 2% approximately, and in order for us to get things continuing, say it still goes down from the 2.3 to 2%, and this is our 2% target. We have reached the point where it's time for us to say, let's raise interest rates. So let's say the 1% it goes from 0 to 1%. Then Fed, and this is what had pushed inflation down to 2%, say. And then we'll find our happy equilibrium we used to have before COVID. And it's going to be like that if, let's say, it's 1.9% inflation, you go to 0.75, or if inflation goes up to 2.1, maybe that means we need to bump the yields to 1.25. And it's going to be this equilibrium that's been always playing about all the time. And this is basically what I saw. So what we've also seen is we have people like Cathy Wood that say, okay, this trend of going up, then going down. So it's going to start going down at like summer, between this August, not summer actually, fall from August to October, or July to October, something like that. It's going to start trending down again. Cathy Wood, CEO of ARK Invest, this is what she said. The Fed expects to have in 2021 short spikes. Then in 2022, it's going to start trending down. And if you're going to say they're going to wait 1 year before to actually raise the rates, then it means they're going to raise it in 2023, which is exactly what they said before when the market was absolutely freaking out. If Cathy Wood's right, then it might be a bit before 2023. But yeah, who knows? Well, only time will tell, I guess. So I think that's it for today. If you enjoyed the video, hit the like button, subscribe to the channel if you haven't already, and folks, hope to see you guys next time.